In the beginning there was the problem. It's not a new problem, but one as old as civilization itself. How do two people who don't know each other, who may be thousands of miles apart, trust one another enough to exchange value? For millennia, the answer was a physical object: gold, silver, a coin you could hold in your hand. Its value was inherent, its scarcity tangible. But as the world grew smaller and our lives moved online, this system of physical trust became a relic. It was too slow, too heavy for the digital age. So we tried to build a digital solution. We created credit cards, wire transfers, online payment systems, but they were all built on a central foundation: a bank, a government, a corporation. They were the middlemen, the arbiters of trust. They could freeze your account, reverse a payment, devalue your savings with the press of a button. They were a single point of failure, a gatekeeper to the new global economy. The digital world promised freedom, but our money remained in chains. Then, in the wake of the 2008 financial crisis, as the world watched the old system crumble under the weight of its own greed and complexity, a document appeared. It was posted to a small mailing list of cryptographers and cypherpunks, digital activists who believed in the power of cryptography to create social and political change. The date was October 31st, 2008, Halloween. A fitting day for a ghost to enter the machine. The document was titled Bitcoin, a peer-to-peer electronic cash system, and the author's name was Satoshi Nakamoto, a name that would soon become the most famous pseudonym in history. Who was Satoshi Nakamoto? To this day, no one knows for sure. Was he a man? A woman? A group of brilliant minds? The mystery is as much a part of Bitcoin's story as the technology itself. But the identity of the author is less important than the idea they unleashed. Satoshi's white paper was a masterpiece of elegant simplicity. It was just 9 pages long. But within it was a solution to the problem of digital trust that had eluded the brightest minds for decades. It proposed a system where a network of users could verify transactions amongst themselves, without needing a central authority. This was the peer-to-peer aspect. The genius was in how it achieved this. Satoshi combined several existing concepts in a completely new way. The first was the blockchain. Imagine a digital public ledger, a notebook that is shared simultaneously with thousands of people around the world. Whenever a transaction occurs, it's written down on a new page in this notebook. This page is called a block. Once the page is full, it is cryptographically sealed and linked to the previous page, forming a chain of blocks. This chain is distributed across the entire network. To change a single transaction on an old page, a hacker would have to change that block, and then every single block that came after it, on thousands of computers simultaneously. It's a near impossible task. This is how Bitcoin achieves its immutability. What's written on the blockchain stays on the blockchain, but who gets to write the next page? Who verifies the transactions? This is where Satoshi introduced the second revolutionary concept: proof of work. To earn the right to add the next block to the chain, members of the network, called miners, must compete to solve an incredibly difficult mathematical puzzle. It requires immense computational power and consumes a great deal of electricity. The first miner to solve the puzzle gets to add the new block, and as a reward for their work, they are awarded brand new bitcoins. This is how new bitcoins are created on a predictable and transparent schedule, and how the network is secured. It was a system of incentives, not authority. Miners are rewarded for being honest. Cheating the system would cost them more in electricity and computing power than they could ever hope to gain. The network is governed by consensus, not by a CEO or a central bank. It is decentralized, transparent, and, for the first time in history, it allowed for digital scarcity. There will only ever be 21 million bitcoins, no more, no less. On January 3, 2009, Satoshi Nakamoto mined the very first block of the Bitcoin blockchain. It was called the Genesis block. Embedded within its code was a secret message, a timestamp, and a headline from that day's newspaper, the Times 3, Jan 2009. Chancellor on brink of second bailout for banks. It was a mission statement. It was a declaration of independence. It was the birth of an alternative. For the first year, Bitcoin was a ghost in the machine. It was a project for cryptographers and hobbyists, a fascinating intellectual experiment with no real-world value. The network was tiny, run by a handful of people on their personal computers. You couldn't buy anything with it. You couldn't sell it. It was just there. The first recorded transaction took place a few weeks after the Genesis block, when Satoshi sent 10 bitcoins to a developer named Hal Finney, who was one of the first people to download the software. It was a test, a simple transfer of code between two pioneers, but it was proof that the system worked. For months, this is how it remained. A small community of believers talking on online forums, mining a few coins here and there, watching the network slowly, steadily grow. They were building the foundation, not knowing if anything would ever be built on top of it. Then, on May 22, 2010, a moment occurred that would change everything. A programmer named Laszlo Hanyecz made a post on a forum. He offered to pay 10,000 bitcoins to anyone who would order him 2 pizzas from Papa John's. At the time, there was no easy way to spend Bitcoin, so a fellow user took him up on the offer, paid for the pizzas with their own credit card, and received the 10,000 BTC in return. It was the first real-world commercial transaction using Bitcoin. It was clumsy, expensive, and utterly historic. It was the first time Bitcoin was used as money, not just a curiosity. Today, those 10,000 Bitcoins would be worth hundreds of millions of dollars. Every year on May 22nd, the crypto community celebrates Bitcoin Pizza Day, a reminder of the humble beginnings of a global phenomenon. Word of this strange new internet money began to spread. It found its first true home in the fringes of the web. On platforms like the Silk Road, an anonymous marketplace on the dark web, Bitcoin became the currency of choice. Censorship-resistant and private nature made it perfect for a world that operated outside the law. This association gave Bitcoin its first and perhaps most notorious use case. It was the currency for outlaws. But this notoriety also brought attention. Tech-savvy libertarians and early adopters were drawn to its promise of financial sovereignty. They saw it not just as a way to buy things anonymously, but as a political statement. It's a way to opt out of a system they no longer trusted. To facilitate this growing interest, the first exchanges began to emerge. The most famous, and ultimately infamous, was Mt. Gox, what started as a platform for trading magic. The Gathering Cards was repurposed to become the world's first major Bitcoin exchange. It was here that Bitcoin was first assigned a price in traditional currencies. In early 2011, it finally broke parity with the US dollar, when Bitcoin was now worth $1. It was a monumental psychological milestone. The experiment was starting to feel real. The price began to creep up, then surge. By June of 2011, it had rocketed to over $30. It was a bubble, fueled by hype and speculation, and it popped just as quickly, crashing back down to a few dollars. Many early adopters were wiped out. Critics declared it a dead fad, a Ponzi scheme, a bubble that had finally burst. But something important had happened. Bitcoin had survived its first major crash. The network never went down. The core technology remained secure. And for those who truly believed in the underlying principles, the crash was just a sale. They began to accumulate. Hodling, a term born from a misspelled forum post meaning hold on for dear life through the long, quiet period that followed. The years 2012 and 2013 were a period of quiet construction. The infrastructure improved. New wallets were developed, making it easier for non-technical users to store their Bitcoin. More exchanges opened up around the world. The community grew, debated, and evolved. Then, in early 2013, the second great bull run began. This time, it felt different. The drivers were more diverse. The banking crisis in Cyprus, where the government proposed seizing a percentage of citizens' bank deposits, sent a shockwave across Europe. People began to look for alternatives, a place to store their wealth that was out of the reach of governments. They found Bitcoin. The price surged past its 2011 high, then $100, then $200. The media, which had largely ignored Bitcoin, suddenly couldn't get enough of it. It was the story of the year. A digital gold rush. By November 2013, the price had exploded to over $1,100 per Bitcoin. This mainstream attention was a double-edged sword. It brought in a wave of new users and investors, but it also brought intense scrutiny from regulators and law enforcement. The FBI shut down the Silk Road, seizing a massive hoard of Bitcoin and demonstrating that while the network was decentralized, its users were not anonymous. And then, the disaster that many had feared finally struck. In February 2014, the world's largest Bitcoin exchange, Mt. Gox, suddenly halted all withdrawals. A few weeks later, it filed for bankruptcy, announcing that 850,000 Bitcoins belonging to its customers had vanished, likely stolen through years of slow, undetected hacking. It was a catastrophic failure of centralized trust, the very thing Bitcoin was designed to eliminate. The news sent the price into a nosedive. It was the Mt. Gox crypto winter. For the next 2 years, the price languished, the hype died down, and the narrative shifted. Bitcoin was dead. It was a failed experiment, a cautionary tale of greed and incompetence. But in the depths of that long winter, something profound was happening. The tourists and speculators had left, but the builders remained. Serious, well-funded entrepreneurs and venture capitalists saw beyond the price volatility. They saw the potential of the underlying technology. This was the era of professionalization. Regulated institutional-grade exchanges like Coinbase and Gemini were founded. They brought security, insurance, and compliance to a space that desperately needed it. The infrastructure matured. The technology became more robust. The conversation shifted from get-rich-quick to what can we build with this? And then, in the summer of 2016, a key event in Bitcoin's pre-programmed monetary policy took place, the halving. Remember how miners are rewarded with new Bitcoins for securing the network? Satoshi designed this reward to be cut in half approximately every 4 years. In 2016, the reward dropped from 25 Bitcoins per block to 12.5. This event is crucial. It means the rate of new supply entering the system is reduced, making each new Bitcoin harder and more costly to produce. It's a predictable, transparent, and unchangeable form of digital scarcity, built directly into the code. The previous halving in 2012 had preceded the 2013 bull run, the 2016 having set the stage for the next chapter. In 2017, the world rediscovered Bitcoin. This time the mania was on a scale never before seen. The price began to climb in the spring, and by the end of the year, it was a full-blown global frenzy. It wasn't just tech enthusiasts anymore. It was your barber, your taxi driver, your relatives asking for advice at family gatherings. The story was no longer about a niche technology. It was about life-changing wealth. The price went parabolic. It blasted through $5,000, then $10,000. The media coverage was wall-to-wall. Bitcoin was a cultural phenomenon. What goes up must come down. The 2017 bubble was the most spectacular asset bubble in modern history, and its collapse was just as dramatic. In early 2018, the price plummeted, wiping out over 80% of its value in a matter of months. The frenzy turned to fear. The stories of overnight millionaires were replaced by stories of life savings lost. The tourists left once again, and another longer crypto winter began. But this time the landscape was different, and the infrastructure that had been built during the previous winter held strong. The major exchanges didn't fail. The network was more resilient than ever. And while the retail speculators were gone, a new, more serious class of observer was taking notes. Wall Street. Throughout 2018, 2019, and into 2020, a quiet but significant shift was occurring. Billionaire investors, hedge fund managers, and publicly traded companies began to publicly speak about Bitcoin. They weren't talking about it as a get-rich-quick scheme. They were talking about it as a store of value, a digital gold, an asset that could act as a hedge against inflation and the endless money printing by central banks. A trend accelerated by the COVID-19 pandemic. In May 2020, the third halving occurred, reducing the block reward to 6.25 Bitcoins. This tightening of new supply, combined with a growing narrative of institutional adoption, created a perfect storm. In late 2020, the dam broke. A company called MicroStrategy, led by CEO Michael Saylor, announced it was putting hundreds of millions of dollars of its corporate treasury into Bitcoin. Then, in early 2021, Tesla did the same, buying $1.5 billion worth. This was the ultimate validation. If a major corporation was willing to bet its balance sheet on Bitcoin, then it was no longer just a niche asset. The 2021 bull run was different from 2017. It was driven less by retail mania and more by institutional buying. The price smashed through its 2017 high and kept climbing, reaching a new all-time high of over $60,000 in April, and then again, peaking at nearly $69,000 in November of 2021. El Salvador even made Bitcoin legal tender. The first country to do so, Bitcoin was undeniably a part of the global financial system. The journey from that $69,000 peak to where we are today, in October 2025, has been another one of Bitcoin's characteristic cycles of volatility and maturation. The market experienced a significant downturn through 2022 and 2023, a period of deleveraging and consolidation that tested the resolve of even the most steadfast believers. It was a necessary correction that purged the excesses of the previous bull run. But the story of 2024 and 2025 has been one of unprecedented institutional integration. The single most important development was the long-awaited approval of Bitcoin spot exchange-traded funds, or ETFs, in the United States in early 2024. For the first time, ordinary investors could buy exposure to Bitcoin through their traditional brokerage accounts, just like a stock or a bond. This opened the floodgates to trillions of dollars of capital from pension funds, endowments, and retail investors who were previously hesitant to navigate the complexities of self-custody. The effect was immediate and profound. The inflows into these ETFs have been consistent and massive, providing a steady institutional bid for the asset. This has fundamentally changed Bitcoin's market dynamics, making it less volatile and more correlated with traditional risk assets, but also cementing its role as a legitimate macroeconomic asset. Today, in October 2025, Bitcoin is trading at a level that would have been unimaginable just a few years ago. The network itself is stronger than ever. The fourth halving, which occurred in the spring of 2024, further reduced the new supply to 3.125 bitcoins per block, tightening its digital scarcity even more. The Lightning Network, a Layer 2 solution built on top of Bitcoin, is gaining traction, making small, instant transactions cheaper and more viable, slowly reigniting the original vision of Bitcoin as an electronic cash system, albeit alongside its dominant role as a store of value. Satoshi Nakamoto disappeared from the internet in 2011, leaving behind their creation and a simple, powerful idea. They have never been heard from since, but their ghost lives on in every transaction, in every block added to the chain. From a 9-page white paper posted by a pseudonym to a global, multi-trillion-dollar asset, the story of Bitcoin is the story of our time. It's a story about trust, about technology, and about the eternal human desire for freedom. It is a chaotic, unpredictable, and often controversial revolution, but it is here to stay. It is the digital native money for a digital native world. In its story, we can be certain, is only just beginning.